Your largest financial leak in retirement has nothing to do with a bad year in the stock market. Right now, millions of Americans over 65 are watching money leave their accounts every single month to pay bills they are no longer legally required to pay. The problem comes down to an assumption. If you're living on a modest, fixed income, you assume the big tax loopholes are written exclusively for the wealthy. If you're a comfortable retiree sitting on a paid-off home and a healthy 401k, you assume basic relief programs are only meant for the destitute. Both assumptions cost you money. The billing system is built on a default state of maximum revenue. Local and federal agencies are specifically designed so that age-based discounts and exemptions do not apply automatically. If you do nothing, you get billed for everything. To see how to fix this, we are going to map out 8 specific exemptions by splitting retirees into 2 profiles: the modest, fixed-income household on the left, and the comfortable, asset-heavy household on the right. Notice how both branches lead straight into the exact same automatic billing trap. Overcoming the friction of government paperwork to claim these exemptions is the highest-paying hourly work you can do in retirement. Let's start the clock. We begin with the Federal Tax Code, which includes a specific provision active for the 2025 through 2028 tax years, the senior bonus deduction. This is a supplemental deduction that stacks on top of the standard one. To claim it, you have to manually verify that your tax software or your accountant adds this specific line item, as it will not appear on your return by default. The math is straightforward. Every person over 65 receives an additional $6,000 deduction. For a married couple, that moves $12,000 of income into the tax-free column, provided your household income is under the $150,000 threshold shown here on the matrix. The trade-off here is a strict 4-year window. This provision is scheduled to expire at the end of 2028, making it a claim-it-or-lose-it opportunity for the next few tax cycles. Dropping down to the local level, we find a similar situation with your property taxes. Dozens of states offer age-based tax freezes or circuit breakers that protect your home equity. These require a proactive step. You must call your county assessor and physically apply for the freeze before their annual deadline, which often passes early in the calendar year. Making that call locks in your school or property tax rate at its current level. It shields your fixed income from being eroded by rising local home values for as long as you live in the house. Local counties fund their budgets by relying on the fact that most seniors will miss these obscure deadlines. Your phone call is the primary tool for defending your monthly cash flow. Your cash flow can also be restricted by IRS Form W-4V, the document that controls how much tax is withheld from your Social Security check. Many people choose automatic withholding just to be safe. But Social Security is only taxable if your provisional income, your other earnings plus half your benefits, crosses specific lines. For a single filer under $25,000, the tax rate is 0%. By calculating your actual liability and filing an updated W-4V to stop unnecessary withholding, you stop giving the Treasury an interest-free loan and keep that cash in your bank account every month. Accuracy is the trade-off. If you underwithhold what you actually owe, you'll face a bill and potential penalties when you file your return in April. You can also eliminate the cost of the filing itself. If your return is limited to Social Security and a pension, you can bypass the $200 to $500 fees at retail tax chains by using IRS-certified TCE or AARP tax aid, which provide professional filing for free. Paying for simple tax preparation or over-withholding money to the government artificially restricts your lifestyle today for no financial benefit. Now we pivot to the right side of our decision tree, the asset-heavy retiree. Your biggest administrative trap is a surcharge called IRMAA, which can significantly increase your Medicare premiums. Look at the lag time on this timeline. Medicare calculates your current premiums based on your tax returns from 2 years ago. This means that in your first years of retirement, you are being charged higher rates based on the high salary you earned while you were still working. You can fix this by filing Form SSA 44. By documenting a life-changing event, like your retirement, you force Medicare to recalculate your premiums based on your current, lower income, which makes that red surcharge line plummet instantly. Filing that single form often yields thousands of dollars in premium savings over the course of a year. Wealthier retirees are specifically penalized by this data lag. Manual intervention via an appeal is your most effective way to recover that capital. Protecting your assets also means knowing when to move them. The home sale exclusion exists to prevent retirees from staying in oversized, expensive houses simply because they fear a massive tax bill upon selling. If the house was your primary residence for 2 of the last 5 years, a married couple can exclude up to $500,000 of the profit from federal taxes. This is gain, not sale price, allowing you to downsize without losing half your equity to the IRS. You can apply a similar shield to your stock portfolio by utilizing the 0% capital gains bracket. This chart shows the valley between your retirement date and the day the government forces you to take required minimum distributions. During these years, your taxable income is often at its lowest point in decades. By deliberately selling appreciated assets during this window, a married couple can realize nearly $96,700 in income while paying a 0% federal tax rate on those gains. This allows you to stack tax-free profit and reset your cost bases before your income rises again. At age 70 and a half, a different strategy becomes available for charitable giving, the Qualified Charitable Distribution, or QCD. Standard charitable giving often fails retirees with assets. Because most take the standard deduction, writing a check to a charity provides 0 additional tax benefit and does nothing to lower your adjusted gross income. A QCD changes the plumbing of the transaction. Instead of taking a withdrawal, paying tax on it, and then donating, you instruct your IRA custodian to route the funds directly to the charity. Because that money never touches your personal bank account, it never registers as income. As these weights fall off, you see the cascading benefit. Your lower income profile automatically reduces your Medicare surcharges and the taxes on your Social Security. For the asset-heavy retiree, the precise routing of your withdrawals is often more valuable than the performance of the investments themselves. The government will never audit you to find the discounts you forgot to claim. Here is your blueprint for both profiles. If you are on a modest income, protect your cash flow. Run the math on Form W-4V, call your county assessor to freeze your property tax, and verify that you are receiving the new senior bonus deduction. If you are managing a larger portfolio, protect your assets. File Form SSA 44 if your income recently dropped, and map out your QCD strategy before required distributions begin. A few hours of bureaucratic friction is the price of keeping thousands of dollars in permanent capital. Right now, filing these specific forms is the most effective financial move remaining entirely in your control. Most Americans over 65 are currently overpaying the government by default. Send this video to a friend or family member who might be missing these exemptions. In retirement, every bill you pay without verifying your legal exemptions is a voluntary transfer of your wealth back to the government.